My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. Um, I'm talking more about using closed-end funds as our investment strategy. If you want the full methodology on the 12 steps to financial freedom, then head over to Facebook and check out my page there called Adaptive Perspective, Navigate Your Finances, where I give you the entire system for free. Um, Maybe at least the entire framework. It's hard to detail out the entire system, but I'm making the college try at doing that. So reminders at the front. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. We've just had cat feeding hour and it's the end of the day prep for the work week. So I am not a financial advisor. I am a financial strategist and I don't speak like the herd. I walk in limited company and sometimes I walk alone and I'm quite okay with that. So my initial, I guess, or my initial thought with this and my regular intro into all of these videos is pretty long, and I really want to cut a lot of that out today. Uh, I started these videos, or I started this video about 4 hours ago, but two back-to-back computer freezes because Microsoft sucks. Or Microsoft used to be amazing, but their Windows product right now sucks and has no patch. And I took that as a great sign to take a break and spend it with my family and yeah, enjoy dinner and some time and come back and attempt these a different time. So in getting back, instead of going through the normal spiel of things, I really just want to think about where the market is overall right now, rehash a lot of the, or at least rehash the advice that I've seen and get into what I would pick for the week. So truth be told, I read a lot. I listen to a lot, but truth be told, no one really has a great idea on what to do right now. I think there's good advice out there, but it kind of depends on your situation and it really depends on your overall strategy. You've got the market at large saying bonds are a great place to be right now, but that doesn't necessarily mean you should be buying bonds right now. That means maybe 9 months ago when bonds were really cheap, that was a great time to buy bonds. It's I've learned the financial end of things. I mean, the Motley Fool, for my opinion, is called a fool for a reason. Bloomberg is generally late to the party on everything. So almost like the news media in general, if the financial world is telling you to look at something, you're better off looking at what they're telling you to not look at. And it might seem like a rabbit hole, but it's really not. Like if the financial world at large is looking at pick your topics, bonds, the dividend off a shipping crate, the Chinese market. Think of what's been popular lately. The technology boom with Nvidia. All of this, if the financial world at large and what is on those talk shows, circuit junkie pathways, if all of those people are screaming and hitting all the different talk shows and saying the same things of like, look at these things, then it's probably worth looking somewhere else because bond market right now is in a really good place if you bought 9 months ago or if you held what you already own. And all this new money is pumping into the bond market and driving up the cost of bonds. That's great. But not if you're looking to buy right now. Um, I think the hoped for real estate market where the Fed finally cuts rates, everybody's on tender hooks waiting for that. Like everybody's waiting for that. But the best time to get into the real estate market, if you're an investor, is now. If you can suffer and make money with the high interest rates right now, like if you can make money off a 6.5% interest rate loan right now, off a mortgage, That's amazing because when the rates drop, and rates will drop, but when rates drop, it's going to spike a housing boom. And that's not so much new construction because new construction is always what, 6 months to 2 years off, depending on where you are. So there's a ton of supply on the market right now, depending on where you live. So if you can find that house and make money at 6.25, 6.5%, then you can find that property at a steal. Versus if you wait until the interest rates drop, when more people are trying to get into the market to buy a house, the overall home values are going to rise. And that's going to make that house you're looking at now just a little bit more expensive because more people are interested at it at a lower interest rate. And that's kind of the market at large. You have a lot of people hoping that rates will go down and prepping for rates to go down, but rates haven't gone down yet. Now, the Fed has held the rate. And because they've consistently held the rate, the overall rate has dropped, but it won't go down as fast. Maybe it'll go down to match the speed. But if the Fed lowers the rates by 1/4%, doesn't sound like a lot. But after however long it's been, 18 months, 20 months of raising rates quickly, fastest rate hike in history, to then pause rates and then lower rates, no one knows how many rate cuts the Fed's going to do. The projection could be three, it could be six. I don't think it'll be six in its, gosh, I don't think it'll be six in a calendar year. That sounds crazy. I mean, my personal bet is they drop the rate in April or May, because then that sets off a really great housing push over summer when people traditionally move. And maybe another rate cut at the end of summer, right when we start off this next presidential election cycle, because it makes them look really good. Okay, now the Fed caused the problem of inflation. Now they get to fix the problem of inflation. And the problem you have is if you believe what they're telling you or not. I mean, we all know inflation went up, and maybe inflation is back down. I would disagree because our cost hasn't changed at the grocery store. You're seeing the easing here and there. Like Cane's dropped their four tender box charge from like $14 to $10, which is still a ton of money for four pieces of chicken and fries. Oh, and the roll or the biscuit, but whatever. That's still a ton of money for four pieces of chicken and fries. Cane's aside, Chick-fil-A is the same way. The prices at fast food might be easing, but until the prices at the grocery store truly change, then inflation isn't much better. So the Fed created the problem, admitted, well, at least on TV, admitted that they had no idea how they created the problem. And then now they've been tasked with fixing the problem when they said they had no idea how it happened to begin with. So now they're fixing the problem and somehow tampering inflation back to 4%, but they'll tell you it's 2%. It's really 4%. Uh, cat noise in the background. And let's see, Fed. Right. So depending what the Fed does with the interest rates and when they do it, it's going to sound amazing, but it's not exactly much different. But the real estate world, that's a big deal. So if the Fed drops rates, that sets off a real estate boom. Uh, the drastically increased home prices, right? So you pay less on a loan, but your home is now worth more. But then that that permeates and infiltrates into the stock market within the real estate and uh, we'll say real estate, bonds, and loan sectors there too. Um, I think, let's see. So if you can find a bond right now, cheap, like for sure cheap, that's worthwhile. If you can, I think oil is always oil, uh, energy infrastructure, so oil, liquid natural gas, LNG. energy infrastructure in general. I think data management, not so much technology. I mean, it's part of technology, but data management, software management, cloud management, that new Matthew McConaughey commercial where he's talking about data is the new gold. That's pretty true. You think of how technologically advanced our society has become, and how technology dependent we've become. Like this video, I mean, this laptop, this mouse, my phone, laptop, if you've got a Surface or a pad, like an iPad or whatever, your refrigerator, all of that's technology based, but it's also all oil based. And we need not so much more outright technology, like having a fridge with a window where you can see inside the fridge doesn't really, it looks cool. It's not really needed. Or maybe it, to me, I'm not here to tell you what you need and don't need. Like it's cool and it's technology, but that's not, I'll say that's not really my game. But if you could figure out a better way for me to manage my cloud data, or a better platform to host my cloud data, or a safer platform to host my cloud data, or a better storage plan that I'm getting on Google for my cloud data, if you could offer that and expound upon that, that's that has greater weight, that has greater applicability, that has a greater money making platform than just targeting how cool the exterior of your fridge is. So it's not just the technology, it's how we're applying the technology. I think if you can find that cheap in the market right now, that's amazing. The problem is the market right now is in the fear and greed swing of things. And what I mean by that, share a screen. So I'll be the first to tell you that I do not watch mainstream media, including Fox News, because Fox News is mainstream media. And I certainly don't watch CNN, but the only thing I will view on CNN is this. I look at their fear and greed index because it's a pretty decent tap on the current investing market. And what swings this pendulum is new money. And I'm not talking like old and new money, like what's in The Great Gatsby. I'm not talking about that. Like new investors. When Bloomberg goes, hey, bonds are where you need to be right now. But that really means that 9 months ago, when we were here, this is when you want to buy. When everybody's scared, well, I won't say everybody, when the people who control this pendulum are scared, and Bloomberg is saying, hey, look over here, and nobody wants to touch bonds because they're really cheap, that's when you buy the interesting stuff. And you buy what, if Bloomberg or CNN or Fox News, or pick your analyst, if they're saying, hey, you should be into this stuff, you want to look at the other stuff and then buy when it's in fear and extreme fear, because you get an amazing deal. And in the closed end fund world of things, the CEF world of things, everything we're buying is on a discount, and not just a discount, like a crazy extreme discount as it is. But we also want to scoop an amazing deal. So if we're forced to buy right now, like we want the best discount we can. But even in extreme fear, when costs are less, because everything's on sale, right? So costs are less, so prices are lower. Get a wider discount, you get a better deal, so that when it moves into extreme greed, you can either A, sit back and just see how it goes. B, you can really hyper focus on what you're buying and compare either by dollar cost average based on what you already have, or watch the discount rise or fall. Um, there's another order that, but it doesn't matter. But right now we're in extreme greed, and unless you can snipe a discount, sell off something you don't want to hold long term, like you're factoring in the rising cost of things. All that new investor money is like, new investor goes, hey, it's a great time to get in because of all this stuff, and you get extreme greed, and things are more expensive, but they don't care because they have the money. and they're not really looking at the cost of things because they hear bonds are great and this is great and this is great. So they put money in. But then something changes in the market and they get scared. And then this pendulum swings back. And then you either buy in fear or you buy in extreme fear. And then for on our portfolio, the general price of things doesn't weigh on us like the market does everybody else because we're looking at dividends for life, right? Lasting dividends, funding a retirement through or supplementing a retirement through dividends and not selling off on stock. So if you buy something here and it's $10, then it backs off and you look and it's $5 now. Like if you've got 10 shares, that's not a huge thing, but if you've got 1,000 shares, that's a little bit different, right? But whether it's here or here, if it pays a 9% plus dividend, whether the price is at $5 or $10, you collect your dividend. Now, maybe the dividend fluctuates a little bit, maybe not. Some of our dividends have not changed at all. Like they're just consistent. And that's amazing. You can argue for and against that. Yeah, it all comes down to an individual strategy. But if we're going to buy an extreme greed, then it's got to be an amazing discount in order for us to consider it, and it's got to fit some other parameters. So on that, this is the closed-end fund master. And yes, these are my notes for this video. The way this works is there's all this data, and the tabs at the top or the spaces at the top somewhat go over the data. So like Olive would be interested. Let's see, Olive. Purple is recommended by somebody. Light blue, we own. Gray does not meet certain parameters. Orange would be a closed fund, but I haven't targeted any of that recently. And what the asterisks mean are this. Our buy alert is a fund that is currently double the historic discount and greater than the 5-year discount. If you look at closed-end funds based on discounts, so let's scale these, which we're going to look based on discount, but that's not quite my point yet. You'll notice there's a ton on discount. If we look at this and rate 0 as the break-even point, but we look at it a little bit differently. We'll say 0% off is like paying $1 for something that's worth $1. So equal trade. It's worth $1, you're getting it for $1. Most people would say that's great. So if it's over, right, or like a little bit less than 1 or a little bit over 1, if it's 1% premium, then you would be buying it for $1.01 instead of paying $1. Or $1.10 instead of paying $1. Or in the case of the most expensive right now, you're paying almost $2 instead of $1. But the opposite version is this. So instead of paying $1, you're paying 54 cents. Or you're paying 80 cents. And that goes back to something, I draw a blank on a name, Warren Buffett says. Like if you can buy a fund for 66 cents instead of $1, that's a really good day in the market. And what he's talking about is not Coca-Cola, Berkshire Hathaway, or Microsoft, or Amazon, or Apple, things that never actually go on sale and discount. He's talking about closed-end funds because Berkshire Hathaway owns closed-end funds. The difference is Berkshire Hathaway does not pay a dividend. And closed-end funds, I mean, it's like a pendulum of sorts, but the average dividend across all funds right now is a little more than 8.5%. So closed-end funds in our strategy, we're looking at funds that have crazy discounts. And then the 2 asterisks are dollar cost average. It's like we own them, but So we own them. They currently don't meet that triple asterisk designation, but it's also less than the our average price of owning a fund. And then one asterisk would just be tracking, like we own it. It's currently selling for higher than it's listed in our portfolio. So it doesn't meet the discount parameter. It's a lot higher it's higher than where we bought it. It just doesn't meet the parameters, but at the same time, we're still going to track it. So if we take all the funds, that ought to be a 1 right now. Oh, number lock got turned off. All right. We go back, make that a 1. So we rank them based on discount. And then I've already pre-sorted these to where the discount is significant compared to the funds over like historical and 5-year discounts. So we come here, paste the data. Interesting that not all of my prior research and musings disappeared off of here. Move the column over 1, insert, shift right, there we go. So we own everything in blue. Purple is recommended by somebody, and green is what we're tracking. And even though I already have a top list, I'm still going to go through how I would do this with you. So everything is significantly discounted compared to its historical average. Even these. I mean, yes, you're paying 98 cents instead of $1 compared to 54 cents instead of $1, but the discount is still significant. So since all of them since all the data is significant, since all the discounts are significant, if we push that off to the side now, we can look at the overall yield. I like things in reverse. So our goal has been to buy 9% and above. The other side of things is we tend to buy things in sets of 50. I like easier math, and I like that form of math. So a minimal stake in something in this crazy market when things are higher than they are normally, even though these are all on discount, and some of them are significantly discounted, or significantly discounted. The price is significantly less than what we've already paid. And I know that, I'll show you. So KYN throws a 9% discount. This is our portfolio, or this is our self-managed portfolio on Webull. So this is our average price. So KYN and KMF merged. It threw off our average and the way Webull tracks it just a little bit. But our average cost to share is almost $9. Cat's upstairs. That's good. This is the current price right now. So it's dollar cost average less than what our current price of share is. It has a 9% dividend, and the discount overall has been lowering over the last several months. Like maybe 3-4 months ago, the discount was almost 20%, and it's been lowering. Historically, the fund runs premium. Yeah, other stuff doesn't make the list. But at any rate, that being said, I don't want to put $50, or I don't want to put 50 shares into a brand new fund in this market where I'm probably going to pay more than I would otherwise. So we're going to eliminate a lot of the list. So our goal has been 9% and above and paid monthly. HQL is a healthcare-based fund, biomedical fund. Yet it's not 9%, But the other reason it doesn't make the long-term cut is it's an automatic dividend reinvestment plan, meaning they pay dividends and they automatically take them back and reinvest them into the company, which over time lowers your buy-in price. But at the same time, you never see the dividends. And I want dividends that are cash in hand, dividends that I can take and then invest in something that I want to buy. So that's not going to make our list. So let's see. Purple, we don't own. So this makes the list because it has the greatest dividend or greatest discount. So if we go back and we scale just by discount. So gray has been grayed out for reasons. So annual yield pays one time a year, not interested in that. This portfolio was bought out by this company and they relabeled it. It's still the same portfolio. It's heavy consumer, not generally my favorite thing, but it also pays quarterly. It pays okay, but this discount hasn't really changed. So if we get into the time frame, so it pays monthly, annual, 4 times a year, annual, monthly, monthly. Although I'm not sold about this one. Quarterly, and so it doesn't really fit the molds. Like that's if we're looking in the top 10, those three pay monthly just based on discount alone. I'm not sold on this one. I like their concept. I don't like how they're aligned. Um, I mean, they're invested in anything energy that's not oil, but at the same time, oil has to be used in order for all of their things to function. Not like I get it, but not a great model. Um, so that really just leaves in the top 10, that really just leaves these two. And that this dividend has narrowed in the last 2 months. Used to be around 30%. It's closed. This one is the widest it's been in a while. Really, the last maybe 2, 3 months, it's been flirting with 50%, but it's the biggest it's been in a while. Go back. Yeah, even after they restructured the portfolio, it didn't widen that much. It's the widest it's been in a while. So it makes the cut. And then, yeah, these, we're just not going to buy anything new. So if we narrow this down further, craziest discount. Data, so real estate, energy, utilities, bonds, data, satellite data, uh, business development company, oil, technology, and then financials. So fluctuating dividend and pays quarterly, not top. Business development, not top right now. Oil stays on the list because it's oil. And this isn't just oil. This is, yeah, like it says, so energy transfer, getting energy from one place to the next, like routing liquid natural gas and oil. It's got utilities. It's energy infrastructure. Um, and I think regardless of the economy, I mean, I think we still have a recession coming. There's the Fed has tinkered with things way too much, and the economy is slowing. I mean, regardless of what the talk show circle junkies say, the economy is slowing. So whether we have an official recession or if they change the terminology again, because they have already changed the terminology, we will have a recession of some type. and oil will still be needed. Uh, you get data, and then this company changed from bonds and then moved their portfolio into senior loans and real estate. And they're run by an exceptional manager. Uh, their company wants to pay a higher dividend. Um, and they cut their dividend in half. So the current portfolio was not able to pay for the dividend, so they cut their dividend during their restructure. And I get why they restructured, because the last several months, several years was bond favored, and we're approaching that time that could be real estate favored with the Fed cutting rates. And I get it, but at the same time, in the meantime, they cut their dividend. So if, because nothing is ever certain in the stock market looks ahead, but nothing is ever etched in stone. So looking ahead, they're poised to do well. And to have the market respond and come back and the Fed drop rates, and that's it. I mean, taking into your account whether you agree with or believe that they lower interest rates that far, if they drop rates, that'll be good for the market. So see how to say this. If the dividend comes back, or if it comes close, you'll snag an amazing deal at an amazing price and a great discount. Um, their sister fund, HGLB, same idea. Oil, great option. And then the counter to all of that is you could go with financial, who stocks in convertibles, not like the top-down convertibles, but they stock in convertibles they can switch between stocks and bonds, which is great for the coming market. And if interest rates lower, then that means the banks will make more money. So, and they pay monthly, and they pay good monthly, and they both cut dividends. So they both cut dividends in this market. Now, in the former market, they had a better dividend, right? So if we go pre-COVID, because no one's really amped back up to pre-COVID levels, but if we go to pre-COVID, and I only know this because I did this earlier, these were the dividends. Ooh, not 0.6, 0.06. These were the dividends. Um, this was pre-COVID. So if we get any kind of hint of that market returning, almost anything becomes an amazing investment. I just know it if we're looking at what the market itself, what the supposed advisors are telling us to do, and they're pumping bonds, I think if you can pick up bonds at an amazing discount, that's great. But how they're telling you to pick up bonds with like junk bonds really are just junk bonds. Or this ETF bond or that ETF bond. It's not that. It's if you can get bonds at a discount, that's worthwhile. Otherwise, you have to look at the other sections of the market that they're not telling you to look at. Uh, this current regime just seems to have a war on anything good for you. So anything on energy and your own ability to have energy at your house. Um, and the best thing with regime change is it generally changes, and the overall culture of our country changes, and not like changes for bad or good. That's not what I'm talking about. But the overall sentiment and cultural awareness and societal awareness of things changes, and we have the overall leadership of our country in a very different position than the average person in our country right now. And the we'll say the average leadership is grossly unaware that the average person has a completely different mindset than them. And we're seeing that polarization more and more, and we'll see it more and more in the upcoming election cycle. But I think what that means for us is, regardless of who's leading, you have to look at the market at large with that out of the equation. But I also think you have to factor that into the equation after you make your strategy. So if this person's in or if that person's in and how that impacts your strategy, that's probably important to know. But you need to have your strategy and not be swayed by all of these other people telling you what to do. So if Bloomberg is pumping bonds and that financial talk show circle group is saying, hey, bonds are the place to be right now, then we should probably look somewhere else. And oil, regardless of who's in, will always be in need. Real estate and the Fed rates, if the Fed drops the rate, real estate's a great place to be. If they don't, then it stays as is. Same thing for banking. So if it's me, if we had to, if we absolutely had to invest, then I would probably break my 9% rule and buy this. But if I had it, if the counter was, you have to follow your own rules. Like, these are your rules, these are what you've said, these are your parameters, then I would probably double. So, and this is what I like to do. So I can compare. You get 334. That's close. Why did that go 80? So that's close in price, but you get an overall better dividend. So if I was able to break the rules, I would probably pick that, just because it's an insane discount and it's hardly ever this cheap. Um, and me, I think the companies run well. They switched around their portfolio, so I have a hope that that dividend will come back. But if I had to follow the rules, then I would go banking, because the goal really is monthly. And if you came back and said, like, what should I do? Like, well, one, it's your money. You're going to make your own call. But say you have $1,000 and you're going to dollar cost every month, regardless of what the market does, whether it's high or low. I mean, yeah, that's dollar cost averaging. Regardless of where the market is, regardless of what it's doing, where would you put money? It's like, well, if I had $1,000 and I was going to dollar cost, I don't think you could buy them all. Yeah, at 1,500. So if you wanted monthly, you're doing something like this. That's close to 1,000. If you're not worried about having one that pays on a quarterly basis, then you're doing something like this. And I mean, you're buying sister companies. These sister companies do different things. These sister companies do some things very similar. So if I had to further divide this out, I would do it like this. Right? You're like, wait, if that breaks your rule, fine. We'll make that one. So that's pretty close to $1,000. That's really about all. That's the closest you can shade it. You get a monthly payer, you get a monthly payer, and then you get something that pays quarterly, which, from my experience, it's labeled a category one. They're supposed to pay 14710. Last year, it was slightly off. It was 13710, so an alternate category one. We'll see what they end up paying this year. And that matters if you're trying to supplement or fund your retirement. You're relying on those dividend payments to come in when they're scheduled to come in, and it matters if that company decides to schedule them differently. So if you had $1,000, or if I had $1,000, and I was going to dollar cost average regardless of what the market was doing, that's what I would do. But as it is, excuse me, but as it is, we're just going to hold, personally, we are just going to hold tight right now. There are several things we're looking at long term. The background. There are several things we're looking at long term, and this greed cycle plays into those plans. I would like to sell this company. The goal would be to sell it with a 20% profit. I don't know if that'll happen. I don't. I mean, current overall total ROI would be that, which is not bad. I mean, that's better than break even. But this is a automatic drip. Like they collect dividends and reinvest them, and you never see the money. Now, you could argue that's good because what happens is, so if you take these out, this is what happens. So if you pay attention to these numbers, but especially this final number, this total ROI. So taking the extra added shares away changes things significantly. The other one is this one. Now it sounds so bad to me selling USA, but it's the same problem. It's an automatic drip, which I'm not a fan of the automatic. I don't like a dividend reinvestment plan anyway, because I want to be able to invest those dividends where I want to invest those dividends. I don't want to be forced to invest with the same company if I don't want to be investing in the same company. So same deal, automatic dividend reinvestment program. Yes, they pay dividends. Yes, it's helping our overall return. Currently, it's greater than a 20% or 20% profit, which is great. Yeah, coming recession, whether it gets turned, whether we officially have one based on talk show dynamics or not, there's debate on whether you should be in that or not. But I really want more consistency. I'll buy quarterly payment or quarterly payers when it's a really amazing deal. But my goal has been more monthly consistent income. But still, I mean, the biggest thing is I want to use this greed to get an amazing escalation of price, or the best escalation of price we can, and sell these early to where I can then use that pendulum swing back into fear when it happens to then buy whatever. Because I'd much rather sell in greed when the pendulum swings back down and buy in fear and extreme fear. And then I knew I bought sister companies, but at the same time, I honestly can't explain why I bought sister companies. I liked this company when we started, and I saw, I mean, yes, they had a sister company. I actually like the sister better. Um, so long term, I mean, yeah, we've held it long. We started our closed end fund only portfolio in, I think, March of 2021, for sure in April, but in March, I think maybe I've sold where we started, but I mean, I like this, but at the same time, I like this one just a little bit better. Um, and it's limiting in a way, but it's not the diversity for diversity's sake, because I think that's Warren Buffett has that on tap as well. It's if you're diversifying your investments in order to have diversity, you're really just wasting your money. And I think Bilbo Baggins says it best, but he's not talking about stocks at all. It's butter scraped over too much bread. Like you're spreading out your investment so far that nothing ever really has a chance to take and manifest and grow. So diversifying speaks more to timidity and being afraid than it does being wise. Like if you're afraid, you tend to diversify and spread out your funds, hoping that you hit some and you know you're going to miss some, and you'd rather balance out than take the risk of being completely wrong or completely right. So being invested in sister funds who invest very similarly, to me, is the wrong way to diversify. It's not like me or us, I'll say us. It's not looking at all these different sections and trying to build a portfolio that does well regardless of the economy, that pays dividends and grows regardless of the economy. So yeah, tech, consumer, energy transfer. I like this portfolio can. Healthcare and biomed, it might be a great place to be, but not in this fashion. Blue chips, people love blue chips, like stalwart technology, stalwart companies, but not in this fashion. Um, in trying to build a well-structured portfolio, not diversified per se, but just a well-structured portfolio, having two sister funds that invest in the exact same things doesn't allow you to then take the other money and either over invest in one or invest in something else. It just seems like double duty, but at the same time not covering all your bases. So, I don't know how else to explain that. So I think long and not like long-term hold, but if the price is right, that might change to a sell at 20% or sell at break even to then take the money and reinvest it in something else. Um, this is the other consideration. It's a long-term hold. Yes, it pays decent, um, but their dividend model hasn't changed. I mean, pre-COVID, or I guess slightly post-COVID to even further beyond COVID, uh, all of the other oil and gas energy transfer funds have increased their dividends, not this one. And I don't know why that is. I like the fund, it pays consistently, but it's not necessarily it's worth more than it used to be. Like that's an added bonus, right? But it's also not escalating its dividend in association to growing their overall stock. Like it's plateaued. So maybe there's a dividend looming. Maybe there's a dividend increase looming. If that happens, if they raise it just a little bit, that price will spike. That's worth keeping around. But that's kind of if this isn't going to change much, then we might just cut our profits and go. So I don't know. But overall for the week, we're going to hold off this week like we did last week. We're going to hold off and see where the market turns. If it continues to go up, then maybe we'll sell some things. If it drops back down, we'll also reevaluate and go from there. So those are my top picks, as well as some rambling and overall thoughts for the week. If you like this video, if you like the content, my random musings, and who knows, the background noises, consider subscribing to my channel. Hit the like button and then head over to Facebook and find me there at Navigate Your Finances, and the information will be below. So whatever you have for the week, I hope it goes well. Wherever it is you're going, I hope you have a plan to get there. And if you have no idea what that means, I talk about that on Facebook. You are the captain of your ship. That ship will go wherever you steer it. So know where you are and know where you're going and know where you want to go. And if you need help with that, just ask. So this is Daniel Young signing off. I will see y'all on another video. Bye-bye.